In this video, we're going to talk about the single best index fund to buy in Ireland. You're not going to want to miss this one.
If you're investing in Ireland, there's one decision that could make or break your wealth building journey. And it's not about picking the hottest stock or timing the market perfectly. It's about choosing the right index fund and understanding how Ireland's unique tax system changes everything. What I have learned through time is that complexity doesn't equal performance. In fact, the smartest investors often make the simplest moves. Today, I'm going to show you the exact index fund I'm buying right now in Ireland and why. But more importantly, I'll show you how to avoid the tax traps that silently destroy returns for Irish investors who don't know the rules. By the end of this video, you'll have a clear, actionable strategy that's tax smart, globally diversified, and built for long-term wealth. Let's dive in. Why index funds matter. To understand why index funds are so powerful, we need to go back to 1976. That's when Jack Bogle, the founder of Vanguard, launched the first retail index fund, the Vanguard 500. Wall Street mocked him.
They called it Bogle's folly. Why? Because it went against everything the financial industry was built on. High fees, active stock picking, and promises of market-beaten returns. But Bogle had studied the data. And here's what he discovered. Most active fund managers don't beat the market, especially after fees, trading costs, and turnover. Year after year, study after study, the results kept proving him right. The few managers who do outperform, they're almost impossible to identify in advance. And even if you find them, their fees often eat up any advantage. So Bogle made a bold, simple call. Keep costs low, stay invested, and own the whole market. Don't try to guess the winners. Just own them all and let the global economy work for you. And he wasn't alone in this thinking.
Warren Buffett, the man who built Berkshire Hathaway, said this: by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. That's not from a TikTok influencer. That's from one of the greatest investors of all time. Still, most of the financial industry ignored the evidence. They kept pushing complexity, smart beta, factor tilts, expert strategies. Things that sound intelligent but rarely outperform once costs are factored in. The truth? The longer your time horizon, the less complexity helps. In fact, it usually hurts. For investors in Ireland, where tax already eats into growth, simplicity isn't just smart, it's strategic. And that brings us to the criteria that actually matter. So, how do you choose the right index fund without overthinking it? You filter ruthlessly. Once you know what matters, you can ignore 90% of the noise. Here are my 6 non-negotiables whether I'm investing €500 or €50,000. Number 1, it must be passive. No stock picking, no star manager, no gut feel calls. That's not investing, that's speculation. Passive means the fund simply tracks an index. No opinions, no forecasts, just rules. History shows that passive funds consistently outperform most active ones, especially after fees. If it's not passive, it's out. Number 2, broad, ideally global exposure. I want exposure to a broad slice of the global economy. That usually means the US, Europe, Asia, and emerging markets. Now, let's be honest. The US makes up over 60% of global indices, and US companies like Apple, Microsoft, and Google earn revenues all over the world. So even if you invest in an S&P 500 tracker, you're getting significant global exposure.
That said, going truly global reduces concentration risk. You're not betting everything on one economy, one currency, or one political system. History shows us that no country leads forever. Number 3, UCITS compliant and domiciled in Europe. This is critical for Irish investors. You'll see a lot of talk online about US ETFs, lower fees, bigger providers, more options, but there are 2 major problems. First, tax risk. If you hold more than €60,000 in US domiciled ETFs, your estate could owe 40% US estate tax when you die. Yes, 40% on the full value, not just the gain. Second, reporting burden. Non-US ETFs aren't tracked by Irish brokers for tax purposes. That means you'll have to self-report every dividend, every gain, every currency conversion manually through Revenue's Form 11. If you forget, you're on the hook. By sticking to UCITS funds domiciled in Ireland or Luxembourg, you stay fully compliant, tax efficient, and under EU regulation. No state tax surprises, no messy paperwork. Number 4. Low fees. The fund must have a total expense ratio under 0.25%.
Why? Because costs compound just like returns. If two funds track the same index and one charges 0.22% while the other charges 0.07%, that difference adds up massively over 20 or 30 years. Index funds are commoditized now. There's no reason to overpay. Number 5. Accumulating versus distributing. This depends on your strategy. Accumulating funds reinvest dividends automatically, great for compounding and clean for tax reporting. Distributing funds pay income directly into your account, which you'll need to declare every year. If you're building wealth, accumulating is usually the easier choice, especially in taxable accounts. Number 6. Currency considerations. If your income and expenses are in euros, but your fund is priced in dollars or pounds, you're introducing unnecessary currency risk. Where possible, choose the euro-denominated version of a fund. It keeps costs down and performance tracking simple. So here's the checklist: passive, broad or global, UCITS compliant, low fees, accumulating or distributing based on your needs, and currency matched to euros. Stick to that and you've already filtered out most of the clutter.
Now here's where things get tricky. While index funds are powerful almost everywhere, in Ireland we face unique tax rules, and if you don't know them, they can quietly destroy your long-term returns. Let me break down the two big ones. The deemed disposal rule. This one catches a lot of investors off guard. If you hold a UCITS ETF in Ireland, you're taxed every 8 years, even if you don't sell. It's called deemed disposal. After 8 years, Revenue assumes you sold your fund at market value and taxes you on the gain, whether you sold it or not, even if your money is still invested, even if you didn't take out a cent. And then it happens again 8 years later, like clockwork. It's like compounding working for you until Revenue steps in and takes a cut mid-journey. The latest budget saw this go down to 38% from January 2026, but currently it's at 41%, exit tax at 41%. In Ireland, ETFs are taxed at a flat 41%. That includes both capital growth and dividend income.
Compare that to direct share ownership, say buying Apple stock directly. Those are taxed under capital gains tax at 33%. Plus, with shares, you get a €1,270 annual exemption, and you can offset losses from one investment against another. With ETFs, no exemption, no loss relief, just 41%. Full stop. So not only are you taxed sooner, you're taxed more heavily. Let me show you what this looks like in real numbers. Say you invest €10,000 in a UCITS ETF. Assume an average return of 7% per year. After 24 years without tax, that could grow to around €50,000. But once deemed disposal kicks in every 8 years at 41%, your actual value drops to closer to €34,000.
That's €16,000 in lost growth, not because you picked the wrong fund, but because of how Ireland taxes long-term investments. The bottom line, index funds are still a powerful tool. They offer global diversification, low fees, and long-term potential. But in Ireland, the tax system changes the rules of the game. And if you don't structure your portfolio properly, you're playing on hard mode without realizing it. Let's get specific. At this point, we've covered why index funds work, what to look for, and what tax traps to avoid. Now let's look at the funds I actually shortlist, the ones that consistently meet the criteria I've covered. Option 1. Vanguard FTSE All World. Tickers VWCE, accumulating, or VWRL, distributing. This is a strong option for broad global exposure. It tracks the FTSE All-World Index covering roughly 3,500 companies across both developed and emerging markets. Everything from Apple and Microsoft to TSMC and Tencent. Here's what you need to know. UCITS compliant, domiciled in Ireland, Physical replication, it holds the actual shares. Expense ratio is 0.22%. Euro-listed versions available. VWCE is accumulating, VWRL is distributing. If you want truly global diversification in one fund, this is an excellent option.
Option 2. MSCI World ETF. Tickers IWDA or SWDA. This one tracks the MSCI World Index, covering 23 developed markets. It excludes emerging markets, so you're getting a more conservative large cap tilt. Why would you consider this? If you want to avoid exposure to countries like Brazil or China, or if you plan to add emerging markets separately. Fund details. UCITS compliant, domiciled in Europe. Physical replication. Total expense ratio is 0.20%. Euro listed version available. Fund size over 40 billion euros, so at excellent liquidity. It's efficient, widely available, and has a strong performance record. Option 3. Vanguard S&P 500. Tickers VUAA accumulating or VUSA distributing. This is the one I personally invest in. It tracks the S&P 500 index, the 500 largest US companies covering around 75% of the US equity market by value. This includes household names like Apple, Microsoft, Amazon, Google, Nvidia, and many more. Here's why I prefer it. UCITS compliant, domiciled in Ireland. Expense ratio is incredibly low at 0.07%. Available in euros and widely supported on platforms like DEGIRO and Interactive Brokers. VUAA is the accumulating version. VUSA is the distributing version. For me, VUAA is the right choice because I want automatic dividend reinvestment without having to handle the paperwork. This choice is also shaped by personal experience. I've been investing in US markets for 15 years. I know these businesses, I understand their fundamentals, and I'm comfortable holding them through different cycles.
Historically, the S&P 500 has delivered over 10% annualized returns since its inception. It's also outperformed most global indices over the past 2 decades. Is it 100% globally diversified? No, but many of these companies generate significant revenues internationally. Apple sells iPhones everywhere. Microsoft's cloud business is global. These are multinational corporations. For me, it's the right balance of simplicity, familiarity, performance, and innovation. That's why VUAA is my core long-term holding. The bottom line, all 3 ETFs are UCITS compliant, euro-denominated, tax-efficient for Irish investors, and backed by globally trusted providers. But when it comes down to it, VUAA is the one I choose, not just because of the cost or convenience, but because it aligns with how I invest. It's focused, familiar, and proven over time. It may not be right for everyone, but for me, it's the cornerstone of a long-term, low-cost strategy. All right, let's move from theory into action. You've shortlisted your fund, it's UCITS compliant, tax smart, low cost. Now how do you actually buy it? Let me walk you through the exact steps. Step 1. Choose your platform. If you're investing from Ireland, common platforms include DEGIRO, Interactive Brokers, and Davy Select. Make sure the platform is regulated and offers access to UCITS ETFs. Some platforms like Revolut or eToro may look convenient, but they often only offer US domiciled ETFs, which create tax complications. For this walkthrough, I'll use DEGIRO, but the same logic applies across any platform.
Step 2. Search for your fund. When you're ready to place a trade, search for the fund by its ticker symbol. For example, VUAA, VWCE, or IWDA. Always double-check 2 details. It's euro-denominated and it's domiciled in Ireland or Luxembourg. Step 3. Check the fund details. Look at the total expense ratio, the annual fee. You want under 2.5%. Check the tracking difference. This shows how closely it follows the index. Lower is better. Finally, confirm how the fund is built. Physical replication, hold actual stocks, is generally preferable to synthetic, uses derivatives. Step 4. Place your order. Go to the search bar and enter the fund's ticker like VUAA. Choose the listing that's in euros and on Euronext exchange. Avoid listings in GBP or USD unless you have a specific reason. Select euro and hit buy. Enter the number of shares you want.
Some platforms only let you buy whole shares. Choose your order type. Market order buys immediately at the best available price. Simple, good for smaller trades. Limit order, you set the maximal price you're willing to pay. Gives more control. Then hit place order. That's it. You now own the fund. What to do next? So you've bought your index fund. Now what? Here's how to turn a good investment into a long-term wealth strategy. Number 1, invest monthly and stay consistent. Set a regular schedule and stick to it. Monthly investing may feel boring, but it's what works. It removes emotion and gets you invested through every cycle. This is called Euro cost averaging. Number 2, don't try to time the market. Buy low, sell high sounds clever. It rarely works. Miss just a few of the best days and your returns suffer significantly. Stop guessing. Stay invested. Number 3, stick to the checklist. Passive, global, UCITS compliant, fees under 0.25%. This simple framework puts you ahead of most investors. Number 4, consider using a pension for long-term growth. If you've got a 10+ year time horizon, a pension could be a better tool. You get tax relief, no exit tax, tax-free growth, and often a lower tax rate when drawing down income. If you're not using your pension to build wealth, you could be leaving money on the table. Remember, you don't need to be clever, you just need to be consistent. That's how real wealth is built. If you want a second opinion on your current setup, or you're not sure how to align your portfolio with Ireland's tax system, I offer private strategy sessions. The link is in the description below. It's designed for business owners and high-income earners who want a clear, tax-efficient investment plan. And if this video helped shift how you think about investing, wait till you see the next one. Why net worth explodes in Ireland after €100,000. I'll walk you through how simple, consistent investing, just like we discussed today, can lead to exponential wealth over time. Thanks for watching, and I'll see you in the next one.